How early should someone contact the bank when considering franchising? When buying a franchise business, you may be able to borrow some of the money against the brand and future cash flow of the business. Understanding the lending and transactional solutions offered to the different franchise systems can be very helpful in knowing what you can potentially afford, and indeed will influence your decision making on which franchise system or specific brand and industry to choose. It would be very useful to have an early discussion about this with a specialist franchise banker, who would also be able to tell you what information would be required when putting up the final deal to get a quick funding approval. This will also help you ask the right questions when buying a business. We hear about banks providing some franchise systems with accredited or preferred status, including advantageous lending packages. What does accreditation typically mean, and how can it help someone looking to buy a franchise? Small business in general presents a high level of risk and would normally require 100% security for bank funding when setting up a new business. In the case of franchising, the strong business and other systems in the better franchise companies and the ability to compare financial results may allow the bank to lend a percentage against the business, even when setting up a new franchise. This means you may be able to borrow some of the money against the brand and the future cash flow of the business. If the franchise system has arrangement with the bank regarding funding or accreditation, that may also include transactional business and personal banking package, which is important to support the future profitability of the business as well. Having access to funding against the business may also mean you can afford a much larger business. What does security mean, and what security is typically needed for a business loan? Banks are not equity or owner investors in the business. In practice, that means they will require security for the funds other people deposits that they lend to you. If you have the appropriate security, you could fund up to 100% of the setup or purchase price, always supposing the business can afford it. In practice, business people may want to use the business as part security to lower the amount of money required from them to buy the business. Typically, the business owner will invest the owner's contribution in the form of cash or free equity in a property and fund the balance against the business and business cash flow using a GSA or General Security Agreement. How acceptable the business would be to the bank for GSA lending would depend on its profitability and, in the case of a greenfield setup, the strength of the brand and if they are accredited for lending and to what level or percentage. What lending options do banks offer typically provide, including repayment options? Everybody's statement of position and circumstances differ, so the bank, sometimes with input from the accountant, should offer different options to suit the customer in the specific deal. This can range from fully secured lending against property or a guarantee, or a typical 3 to 5 year business term loan, equipment finance, where the equipment provide their own security, or overdrafts to cover working capital, amongst others. The cost or the interest rate charged would also differ depending on the security offered in each case. Another item that is very important to the cash flow of the business is the debt structure. For instance, the cash flow implications of $100,000 in debt can be between $900 to $3,600 per month, depending on the term. That's the time the loan is over, and the interest rate, which is dependent on the type of security. What preparations would you expect someone to have undertaken before making contact with the bank, and what preparations should they have made prior to a lending decision? Obtaining bank finance might seem to be a big issue, especially for first-time buyers or small businesses. In fact, it's essentially an easy and straightforward process using the same information you would need yourself to assess the business. The bank will look at the buyer's own financial position, that's the statement of assets and liabilities, first. the bank will want to see a breakdown of the purchase price of the franchise and factors like details of the franchise location and demographics of the area if applicable. After that, they will look at information that will become available in the process of assessing the business. Regarding cash flow projection, a bank typically needs a 12 months cash flow projection for the proposed business, including a list of the assumptions used to determine the figures. If the business is an existing one, it will also want to see the historical financial accounts. In the case of a new franchise, the franchisor may provide a cash flow model that you can use to project expected expenses and income and the resulting cash flow position. This would be based on expectations and on what other similar stores in the system are doing. These are not guarantees, of course, but in a solid franchise system with good track record can give a very good indication of possible performance. If done properly, with the assistance of your accountant if necessary, cash flow projections will tell you about the real value of the business as well as how much the bank finance you need to obtain. Regarding business plan, producing a business plan is a very worthwhile exercise and need not to be elaborate in most cases. It will help you to understand the business you want to purchase better and to focus your thinking and to convince the franchisor and the financier of your abilities. It should include aspects like the explanation of how you plan to run the business, who will be operating the business, for instance, yourself, manager, family members, and also their abilities. The working capital required, information on the market environment, and background on the specific franchise under consideration. Regarding your finance request, getting the finance you need is not usually a question of just asking for a loan. You want to borrow the right amount of money only when you need it and on the best possible terms. Different needs can be financed in different ways. For example, short-term working capital via overdraft, medium-term business finance via a term loan, and funding equipment or vehicles via equipment finance, which provides tax benefits and can use the item itself as security. The bank would look at the term of your franchise agreement, the debt servicing capability of the business, and the particular needs of the industry in determining the best mix for your individual funding needs. What insight, guidance can a bank provide as part of the process? You should see your franchise banker as an ally that can give you some good advice on potential funding solutions, questions to ask, and pitfalls to look out for. Remember, as their customer, the bank would want you to be successful, and your interests and theirs are pretty much in alignment, at least for the term of the lending. Because of this, some banks have specialist franchise units that may already know the systems that you're interested in and what figures are realistic. They would be able to provide information on the questions to ask the franchisor and other parties when looking at buying a franchise business. What information is required to obtain the funding, and should also be able to offer transactional and system-specific solutions for the system you are interested in. What are some of the common issues that banks have with unsuccessful loan applications, and what can someone looking to buy a franchise learn from this? Franchise systems have their own selection criteria on who should make a successful franchisee. Once approved, the most common causes for the bank being unable to assist with funding would include a lack of owner's equity, not understanding or presenting the numbers, lack of profitability, and or the business not being able to afford the debt structure, which may include a lot of external personal and property debt as well. The potential franchisee can get around these issues by knowing the numbers, presenting a realistic business plan and cash flow projections, and getting some professional advice. In many cases, getting the bank involved in the early stages, if they have specialist franchise unit, would be very helpful to understand what is possible. How does the lending process and structure differ for an existing business versus a startup or greenfields franchise? In the case of an existing franchise business, the amount the business can afford to repay, which in turn determines how much you can fund against the business, would be directly determined by the profitability of the existing business and how much you are paying for the business. With a new franchise setup, you would not be able to fund against the future cash flow of a non-existing business and would need more security or cash, unless the franchise system is accredited with the bank. In the case of an accredited system, how much you can lend would be dependent on the realistic projected income and how much the bank would be prepared to fund against that particular brand.